For the half year, we were very pleased with the Qube half year results overall. I think if you looked at the headline numbers, it did show a negative compared to prior year, but we have called out that the prior year had 22.2 million of net pre-tax contribution from our shareholding in Asciano, which was part of that Asciano transaction to acquire Patrick's. We bought shares. And so prior year had a one-off in regard to that. So look below the headline numbers is really the message on that. We tend to, and I think the market tends to look at Qube today as sort of three components, if you like: our underlying core businesses of our logistics division, our ports and bulk division, and a few associates that are joint ventures that we have. The second parcel the market obviously looks at is Patrick, given the size of that 50% equity interest in Patrick. And the third is really the Moorebank project, and what does Moorebank mean for Qube. And so it's in that context that I'll just briefly talk about each parcel. The underlying businesses had a really good result for the 6 months. Our ports and bulk division earnings up 20% on prior year, and that was really on the back of a reduction in the number or the tonnes of iron ore that went through our Utah Point facility in Port Hedland. Prior year about 12.7 million tonnes. This half year, about 10.3 million tonnes. So that is a facility where we spent capital in. The returns on that are higher than a traditional logistics return. So for that division to deliver a 20% improvement, it was a really, really good result. We're extremely pleased. Essentially, it comes on the back of higher volumes across most of the activities that we're involved in. Very strong log exports out of New Zealand into China through that ISO acquisition we did a couple of years ago. Very strong imported motor vehicles in the ports business through our AAT interests. Generally good volumes across most of the commodities except for that iron ore. And in our half-year results, you see a pie chart where iron ore reduced to about 10% of the revenue of that division. So essentially, across not only ports and bulk, but logistics, the whole strategy to diversify by geography, diversify by product, really helps us to manage those ups and downs in various commodities or goods that we're handling through our various businesses in that import-export supply chain. The logistics division generally had a very good result. Revenue up, earnings up in every state except New South Wales. And New South Wales dragged down the overall results for our logistics division. Principally driven off three things. The first two, drought. The drought in New South Wales and southern Queensland, which really reduced grain volumes. There was virtually no grain through Port Kembla, through our Quattro facility in Port Kembla. That affects logistics in two ways. The first is the bulk grain contracts that we have for rail, moving bulk grain by rail to Port Kembla and other ports with the three partners in that Quattro joint venture. So there was very low grain volumes on rail in bulk. There was very low containerised grain exports, which is the second area of decline. And the third for us was the impact of losing and the expiry of the lease at Port Botany, what we call Sydney Haulage, which is the empty container park rail terminal adjacent to the container stevedoring businesses at Port Botany. That lease expired in April last year. DP World Dubai, not DP World Australia, chose not to renew that lease with us. And those who have followed us fairly closely, we did make an acquisition just prior to Christmas of Maritime Container Services, MCS, which is the big empty container facility with rail at Cooks River, just under the airport, the flight paths, as you see when you come into Sydney. So we really had an impact from the loss of that Sydney haulage, having to run empty containers through our Yennora, through our Minto operations, not getting the scale and efficiencies of having them through Port Botany. That MCS acquisition we did undertake essentially without ACCC approval. The ACCC then came to us and said that they wanted to do a post-acquisition review, which we then gave some undertakings we would let it operate separately. and the ACCC finally cleared it last week, and so we're starting the integration today. So you're really not going to see much impact from that acquisition until next financial year. So second half, we'll still have some challenges around the whole movement of containers from an import to an empty to an export, and without that site at Port Botany, and that's really the main impact in logistics. Generally, the guidance we've given is that that impact across the division was in the order of 5 to 10 million at the EBIT level. About 60% of that is related to the drought and the grain, and about 40% to that Port Botany issue. The second area I'll just spend a few moments on is Patrick. We're extremely pleased with where Patrick has got to in a very competitive market with a high degree of competition and pricing pressure from particularly the main competitor in DP World trying to preserve market share using price. Having said that, the Patrick Group is now completely separated from all of the old Asciano systems, that some of which stayed with PN. The management is all in place, sort of 15 months down at the end of the year from that acquisition. We've taken out significant corporate costs. The management team has renegotiated and extended the contracts of the majority, in the order of 85% of that business that's at Patrick's has been extended. The two main contracts with Maersk and MSC, the number 1 and 2 in the world, have been extended to late 2020. We've continued with the implementation of the automation project here in Sydney at Port Botany, and that's now delivering much better crane rate and productivity performance. Still not where we want it to be, but it's a significant improvement from the levels that it was at when we took over the business. So generally, our view is in a very good position. The next 12 months sees a large portion, the majority of DP World's business coming to the market, so there's opportunities for Patrick to secure some more business. If you recall, Patrick lost a contract in the first month of our ownership, not through our management team, but everything that had been done prior to that. Since that date, we've picked up 3 smaller contracts. We haven't replaced that volume yet, but we're certainly keen to add some more volume into the Patrick business. Those that follow our market very closely will know that Maersk, Patrick's number 1 customer, has acquired Hamburg Süd, the German shipping line. That went through regulatory processes overseas, finally approved just before Christmas. Majority of Hamburg Süd's business sits with DP World, the competitor, so we're again hopeful that some of that business may come to Patrick. So in all, very happy. I think the point I'd call out just on financials around Patrick, some in the market took the old Asciano numbers of EBITDA around 240 million a year and then extrapolated that out and really didn't go into and delve into those that 240 number for 2 years in a row, had a number of one-offs. So the real guidance we've given is that the underlying trading results of Patrick pre-acquisition was closer to the 200, 205 million EBITDA, not the 240 that Asciano had been reporting, based on some property sales, sale of the technology company, which they should never have done, but they did, back to Kalmar. So in all, we're reasonably happy with where Patrick's is at. The third area is obviously Moorebank. And I think the market sort of is looking for all the new leases. When are we signing all these leases on Moorebank? I think we just want to guide caution there that the official deal was only done and commenced in January last year. And so we're really only just over 1 year into this project. We've announced the target lease. We have building warehouse for Qube Logistics. And at the results, we announced a reservation arrangement with a large importer. They've sworn us to confidentiality, so we're not in a position to disclose who it is, but we've agreed, and the documentation's being prepared now, but commercially we've agreed to reserve 150,000 square metres of land at Moorebank for this party. They are going to pay us a fee. The arrangement is that we will now enter into discussions and negotiations around entering into an agreement for lease. They have wanted up to 4 years to do that, but have indicated to us that they want to do it much quicker than that, but the arrangement is for up to 4 years. and then another 3 years is the total reservation agreement. And if there's no agreement for lease within 4 years, the annual fee increases significantly. It's fair to say that the tenant, the potential tenant here, is a key target tenant and someone that we would want on Moorebank, and that's why we've entered into this arrangement. We have planning processes to go through, so we're at least probably 2 years away from part of the land being able to have planning approval to build warehouses on part of the land, so it was not a major issue in terms of an opportunity cost to not go down that path. So I think I'll just finish by saying, look, our guidance is pretty much the same as it was at the full year results. We, barring any external major macroeconomic event, expect that the business will continue to perform as it did in the first half through to the second half. We're continuing to invest in opportunities across most of our businesses, new tenders, new contracts, new equipment, new facilities, etc., as we've been doing.